Hey everyone, welcome back to the Bitcoin Fortress podcast. This is episode 181, recorded on September 14th, 2025. No shitcoins, no hype, just Bitcoin. We are at block height 914680, Moscow time 864. Fees are 1, 3, and 4. We've got 31 stories this week. Some are a little bit overlapping, different news sources and whatnot. But we'll be covering corporate treasury, state level adoption, minor expansions on chain metrics, regulatory developments, and more, all with some numbers, context, and clear takeaways. The goal, when you finish listening, you should understand not just what happened, but why it matters. Don't forget to check out this week's Bitcoin Fortress Substack feature, Bitcoin Under the Hood, Part 2. We'll include links in the show notes to that. And with that, let's jump in. So, first up, we have corporate Bitcoin proxy stocks cooling as premiums compress. The hubbub on the interwebs is the end of paper Bitcoin summer. So, what's happening? So, public companies and governments now hold 1.5 million Bitcoin, or 7% of supply, worth about $173 billion. MicroStrategy alone owns 638,460 Bitcoin at about a $70,000 to $74,000 per coin cost basis. So, all in profit at current prices. But equities like MicroStrategy, Marathon, Riot, and all these Bitcoin treasury companies actually probably more appropriately than the miners. Miners do trade a little bit differently. But certainly the Bitcoin treasuries are trading now much closer to their net Bitcoin value on the balance sheet, as spot Bitcoin ETFs give investors what is essentially direct and cheaper exposure, because for a while there, these treasury companies were trading, especially MicroStrategy, at a premium to the Bitcoin that they hold. Why, you ask? Well, largely because they employ leverage, using debt basically to acquire more Bitcoin so that they have more Bitcoin per common shareholder. But then, of course, when they issue equity, that dilutes the common shareholders, and so that's good as long as the price of Bitcoin is growing rapidly. So basically, the premium and discount sort of cycles in these Bitcoin proxy companies to reflect changing risk appetites. So if people are particularly risk on, Bitcoin, say, blowing up, people are willing to pay a premium for these Bitcoin treasury company exposures. Um, Now that's sort of trending back to, I guess, what you would call par, or, the value of the actual Bitcoin on the balance sheet. ETFs really reduced the scarcity premium, which was previously baked into some of these equities. So, bottom line is, if you want to mess around with proxy companies, you need to watch the risk of dilution from, especially when they do at the market equity raises, because that may not be a good thing. And also at what rate they're accumulating treasury. And my own opinion is, if you really want to invest in these types of companies, MicroStrategy is probably the quote safest bet of them all, since they've been doing it the longest and they seem to know what they're doing. But there's also this thing called Bitcoin that you can just buy and self custody. Stay humble and stack sats. Next up, the S&P 500 committee rejects MicroStrategy's inclusion. So, despite an over $100 billion market cap, S&P's committee cited, quote, earnings volatility from the heavy Bitcoin concentration. And so they said, no. Of course, the inclusion in the S&P 500 for MicroStrategy would have triggered billions in passive inflows, from all these index funds that track the S&P 500. So basically, it sounds like the index committee wants diversified corporate earnings, not single asset exposure. Um, and any treasury companies that want to be included someday, and again, none of them are even close to being the size of MicroStrategy, they would have to address governance, reporting, risk metrics, and all that other stuff. Kind of interesting to me too, how it's sort of like a little small group of people deciding who gets to be in that. It's almost like the Federal Reserve deciding interest rates. So it's just fiat world, and this is what they do. So instead of MicroStrategy, I guess they put in a dating website and I don't know, something else. I don't know. That's supposed to represent the American stock market, I guess. But anyway, that was interesting news for the week. Next up on the macro check, we've got sticky inflation, weak jobs, and Fed cuts looming. Maybe. We'll see next week. CPI is running 3.2% year over year versus the 2% Fed target, which they kind of are now soft shoeing and saying, well, we're a little bit more worried about jobs than we are inflation, to be honest. Non-farm payrolls missed by 40,000 jobs. In case you also missed it, they keep revising the numbers lower. So all the jobs that we thought we had, we don't really have. Which, of course, we all know the government data is garbage, but that just really puts an exclamation point on it. Fed funds futures now implying 225 basis point cuts by December if we continue to see a soft labor market, which seems to be the trend. Bitcoin has been resilient even as the macro data sort of whipsaws the traditional markets around. Obviously, liquidity is good for Bitcoin, and so rate cuts are supportive for risk assets in general. But of course, there's always the tail risk of policy surprises. And so, yeah, so just stay humble, stack sats. But it's good to see that, you know, Bitcoin's holding up pretty well and will probably do quite well if the Fed turns on the money printer full blast, which seems like they're headed towards. September seasonality could be breaking. We have a 3-year streak of, if you go back historically, September has usually had about a 6% average monthly negative, sorry, 6% average monthly return for Bitcoin. But for the past 3 years, we've seemed to have avoided any major drawdowns, which is probably helped by 15 billion of year-to-date ETF inflows, which has sort of created structural demand for Bitcoin and kind of reduced the volatility, I guess, and the ups and downs related to what was primarily retail demand in the past. Again, could be breaking old seasonal patterns. We'll see. We're only halfway through September at this point, but we shall see how we end the month. Um, but again, accumulation focus is being replaced, is replacing trader seasonality narratives. So uh, something to watch. And we may still have a red September. You don't know. And if we do, great, buy more. Next up, the U.S. Strategic Bitcoin Reserve Study is gaining some momentum. So, Treasury was ordered to report on a Bitcoin reserve feasibility within 90 days. Now, the U.S. already holds 198,000 Bitcoin, worth about $22 billion from DOJ seizures. China has about 190,000 Bitcoin. The UK has 61,000 Bitcoin. The Ukraine has 46,000 Bitcoin. So lots of countries already have pretty decent sized reserves. But implementing a formal reserve raises a number of different issues, questions, concerns, such as custody. How are you going to hold the Bitcoin? Funding. How are you going to get more? They had talked before about revenue neutral. So obviously, if they steal Bitcoin from criminals, that's a great source of revenue neutral funding. And then you have maybe, I don't know, seizures, forfeitures, whatever, but they don't want to use tax dollars. So, but that's a question mark. And then also audit policy questions as well. Like, who's going to, I guess if it's in a wallet, you don't really need an audit, right? You can just look at it like sort of like El Salvador, they post their address and you can go out there and look and see their daily buys and that their stack keeps growing, and that would be just wonderful transparency. So we'll see what we get from the US government on that angle. It does signal again that Bitcoin is moving away from a fringe asset towards a more sovereign monetary asset status. Um, but it's still early. Next up, OnRamp launches an institutional Bitcoin advisory suite. So, OnRamp is a company that offers SOC 2 compliant custody, policy templates, risk frameworks for fiduciaries. So, again, the big dogs, they're targeting pensions, endowments, corporate treasuries that are new to investing directly in Bitcoin. And these entities have a lot of money and face a lot of scrutiny from their overseers and certainly the people that they are supposed to be benefiting. And so this kind of stuff is really important to them, especially the internal controls and all that other stuff that's needed to make sure that that they don't lose their coins. So this really bridges the gap between ETFs and self-custody solutions. So they could custody it themselves, but probably don't have the expertise in-house to do it, and maybe they don't want to buy ETFs, even though that's the easiest way for them to get exposure to Bitcoin. So this is kind of again a bridge. And these institutions really need legal clarity. They want insurance. They want strong operational procedures. So they really want everything to be formalized, again, to make sure that the assets stay put and don't float away. Africa Bitcoin Corporation, ABC, was listed. This was a company called Altvest Capital, which rebranded as ABC, which is the first African listed Bitcoin treasury firm. So there's another one. Inflation is currently over 15% in Nigeria, and I think also in Kenya, which is driving hard asset hedges. It certainly gives people another option besides holding Bitcoin directly. And of course, this is a regional precedent for corporate balance sheet Bitcoin in Africa, which is joining the party. We already have obviously a lot of US companies. There's some companies in Japan. I think there was one in South Korea that we covered last week, and now Africa. Again, governance and custody transparency will be key for investors to adopt these companies, and so it'll be interesting to see what ABC has planned. But hopefully, it's pretty tight. American Bitcoin (ABTC) begins their Nasdaq trading. Again, we've talked about this one before. They're kind of a hybrid. They have mining revenue plus treasury Bitcoin accumulation. Um, their IPO funding was going to be used to buy 10 to 24 exahash per second of mining expansion plus direct Bitcoin purchases. So again, this gives you public market exposure to both mining economics and Bitcoin price upside. So again, this stock might trade differently, may trade kind of in between, like a Bitcoin miner and a Bitcoin treasury company. And again, the risk profile is different than a pure treasury play like MicroStrategy. So again, for people that are interested in investing in this part of the stock market, could be interesting. Personally, I don't really like the stock market that much, but that's just me. Metaplanet raised some capital in Japan for Bitcoin purchases. Shareholders approved an equity raise while the yen is trading at 165 yen per US dollar, which is extremely weak. And they have negative real rates there in Japan because they just do. And Japanese corporates in general hold something like $3 trillion worth of cash, and could be wanting to look for inflation hedges. So, uh, Metaplanet, of course, signals that Asia corporates could be turning to Bitcoin amid currency weakness, although admittedly, this company is a Bitcoin treasury company, but it sets a precedent, and we do see a little bit of that happening in the United States now, where companies are actually getting Bitcoin on the balance sheet, but not, changing their whole business to acquisition of Bitcoin. And it, again, could trigger copycats if the early adopters outperform peers. And so time will tell. Next up, Hive Digital mines 247 Bitcoin in August, which is up 22%. So their hash rate average was 16.3 exahash per second. The peak was 18.1 exahash per second. Their Paraguay expansion was aiming for 25 exahash per second by Thanksgiving. They report their fleet efficiency now at 18.5 joules per terahash, and their margins, um, which, yeah, is the difference between the price of Bitcoin and their cost of mining, is near 50 to 60% post energy costs, which is pretty amazing. I think this is a good example of why Bitcoin miners tend to outperform Bitcoin in up cycles, is because they're leveraged, not much different than gold miners, who have, by the way, been having quite a run this year, if you follow that space. So the efficiency leaders will tend to be the ones that survive the halving cycles, while the high cost miners will exit. A lot of them will just go out of business or get acquired by the bigger guys. Um, so scale and cheap power do provide competitive post-halving advantage to miners. Although we do get a little concerned when we see too few mining companies, and so that's why, at least that's why I plug in a couple home miners here. You could buy a BitAxe for $100, $200, and plug it in, and you can support the network and decentralized mining. And who knows, you might even find a block. Of course, you have a better chance. Well, actually, you have a better chance of finding a block with a BitAxe than you do of winning the lottery. So I guess that's one way of looking at it. Next up, spot Bitcoin ETFs see record inflows. There were last week $757 million of inflows on Tuesday, 553 million on Wednesday, and year to date over 15 billion. The ETFs now hold 330,000 Bitcoin. So ETF inflows are more than absorbing new supply. I think I can't remember the exact number, but something like 4 times the daily supply that's coming out of mining is being absorbed by ETFs and other corporate buyers. So this is really tightening the liquid Bitcoin availability. Although custody concentration risk is rising. I think BlackRock outsources their custody to Coinbase, if I'm not mistaken. I think Fidelity does their own custody. I think. But anyway, those two entities are dominating the flows. So there's, of course, always the concern that they keep their Bitcoin custody very, very, very robust because that is a big honeypot for hackers to get into, although it's would be pretty hard. And I'm sure they have some pretty sophisticated key and vault strategies that would probably blow your mind if you knew what they actually did. But anyway, something to watch. Next, we have whale distribution versus long-term holder supply. So we've heard a little bit about whales dropping large amounts of coin for sale on the market at certain times, which then causes Bitcoin price to drop, and then it rebounds. So this is, kind of your normal distribution that occurs whenever there's a bull market. So whale spending has spiked, but 76% of the supply has remained unmoved for more than a year, which is actually an all-time high. So even though there is some whale spending happening, overall the amount of supply has pretty much stayed put, which means people are hodling. And exchange balances are less than 2.3 million Bitcoin, which is the lowest since 2018. Again, low exchange balances means not a lot for sale, although a lot of the big boys do the OTC trading, which doesn't really register on the exchanges, and it's a little less visible on price movement. But you could probably bet they're trading pretty close to what the quoted market price is. I mean, I can't imagine that there would be huge differences happening in that market. Um, but I don't know. We don't really see that. All we see is what's trading on the exchanges. Again, long-term holders are anchoring supply even amid profit taking, and illiquid supply growth supports the bullish long-term thesis. Paper Bitcoin unwinding as physical scarcity narrative returns. So this is another take on the paper Bitcoin summer. Futures open interest is down 18% since August, and option volumes are down 25%. Maybe the people getting wrecked on both sides has something to do with it. I don't know. But spot and self custody demand is rising from corporates, ETFs, and sovereigns. So the leverage flush that occurs, and you see it all the time, is strengthening the scarcity dynamics in physical Bitcoin. And this is bullish if the structural buyers keep absorbing the declining float, which seems to be the trend we're on. So now, will you still have an options market? Of course, because people are going to want to hedge. They might want to protect the downside of their position. But just the pure speculation just is hazardous to your net worth. And that's why it's always better to just buy physical, buy spot, put it in cold storage, and just forget about it. It's the easiest thing in the world to do. But some people, they're bored with that stuff. They want excitement. They want to gamble. So yeah, then they do the futures market and get wrecked on the upside and the downside. Fed rate cut odds rise, and what could be the impact on the Bitcoin market? Futures pricing something like 50 bits of cuts by December. Real yields have actually been falling since July. And again, as we mentioned earlier, past easing cycles have preceded bull runs, and this would be in 2013, 2019, 2020. If you remember, the Fed started cutting rates last year and then they stopped and they haven't done anything for 7 times. And now, of course, the labor market's in trouble and inflation's still a little bit high and they're getting a lot of pressure. And the system cannot survive without more liquidity. There must be more borrowing in fiat. The debt must grow or everything collapses. That is the reality, folks. So, again, rate cuts support liquidity sensitive assets like Bitcoin. Inflation surprises could be a risk to the easing path, but let's be honest, it doesn't really matter unless inflation gets really out of hand. They're going to want to lower rates to help the economy continue to grow. And who knows, they may even start QE again at some point. Only a matter of time. Hash rate and difficulty hit all-time highs. So again, hash rate for the network was 700 exahash per second. Difficulty adjustment recently up 6%. Miners are holding more of their Bitcoin that they're mining, which is signaling confidence. The upshot here is network security is stronger than ever. Rising difficulty squeezing inefficient post-halving operators, and so that is a continuing theme. Uh, Next up, miner holdings are at a 90-day high. So again, as we mentioned, miner reserves are the highest since June. Daily Bitcoin miner sell pressure is down 20% month over month. So they're, again, the miners are your natural seller in the Bitcoin ecosystem because they're mining the Bitcoin. Typically, they need to sell it in order to raise money for payroll and to, service their debt or buy more equipment or whatever. So they are the natural seller. To see them not selling as much is bullish. This signals confidence. Less Bitcoin hitting exchanges supports price stability. And of course, again, historically, it's been bullish when the miners accumulate instead of distribute. So other than the miners, where else do you get your Bitcoin from? Well, from the whales, and some of them are selling, and good for them. They made a lot of money, but they're probably going to miss out on a lot more. But that's just who knows, right? Tether USAT stablecoin launch. So USAT is launching under the Genius Act compliance. Their reserves will be held by Cantor Fitzgerald. Surprise, surprise. Secretary of Commerce. Custody will be held by Anchorage Digital, and it will be led by the ex-White House advisor, Bo Hines. So this is a full compliance pivot, which signals the maturing stablecoin sector. And of course, Tether doesn't want to miss out on the action in the US, so they launched a new coin that will be fully US compliant. I assume the USDT will continue to float around out there in the world. And this could drive institutional adoption if regulatory clarity boosts trust in it, which it should. So it'll be interesting to watch. The interesting thing about the stable coins too is they don't pay a yield. So um, that's great, really, for the issuer because if they don't have to pay a yield to people that hold the USDT, or USAT, they get to keep all the interest income that they're earning on the assets that they're buying that are collateralizing, which makes them even more profitable than they already are. And I think Tether is like incredibly profitable if you look at it on a per employee basis. Um, 'Cause they have a very small group of people and they make a lot of money. Um, so it's a good business to be in. But I think at some point they're going to have to start offering people yield because, like, it's if you get 0.2% in your Wells Fargo account and you get 0% holding stablecoin, eh, I don't know. It's not a lot of money, but still. Bitcoin hoarding equities pull back. Of course, we've heard this before, but MicroStrategy stock, a little more detail here, is down 28% from its July highs. Ouch. Metaplan is down 60%. Ouch. And then some of the smaller Bitcoin equities are down 60 to 70%. So, is it time to buy these undervalued stocks? Ah, I don't think so. But yeah, that's not my cup of tea. Equity exposure does not equal direct Bitcoin. Got to remember that, folks. Leverage does amplify volatility. If you think Bitcoin's going to have a big run into the end of the year, though, and buy some call options on this stuff. I don't know. If you want to gamble, go for it. But that's the risk that you run when you buy Bitcoin treasury companies. There's obviously been a rotation back to spot Bitcoin. ETFs have seen strong inflows and perhaps self-custody. I mean, that's happening too. I mean, I'm certainly pushing for it. Everybody in the space is like, yeah, you should hold your own keys. So that drains liquidity away from not only the ETFs, but as these Bitcoin proxy companies as well. So the summer of paper Bitcoin is over, folks. Miner margins are compressing on costs. So the hash price index is down 35% post halving. Energy prices are up 12%, difficulties up 6%. So again, smaller miners are at risk of capitulation or M&A takeovers with this type of a situation occurring. It's getting very difficult to make money for the small operators in the mining space. But of course, as we said earlier, the efficient operators can expand their share during weak margin periods and then make lots of money when the Bitcoin price takes off and their operating costs stay relatively constant. Bitcoin price popped to 115 after the CPI data last week. The CPI print was in line, and then Bitcoin jumped to 115,150 on a relief rally after it was trading down quite a bit. It does show Bitcoin's continued and growing macro sensitivity. And of course, rate policy and inflation expectations do remain key catalysts. It's always interesting to me when the inflation prints higher than what people expect, and then it causes the Bitcoin price to go down because I'm like, well, isn't that what Bitcoin's for? Isn't that, I mean, I look at it that way, but the market still sees it as a risk-on asset. And so you always have to kind of remember that when you're watching the price, which you shouldn't do, at least not too much. Tether's regulatory shift, we talked about this earlier. They're hiring an ex-White House staff person, launching a U.S. compliant stablecoin. Um, they're going to be aligned with the 2026 U.S. regulatory frameworks that are coming into effect. And it's probably going to force the whole sector towards stricter compliance standards. If you want to play in the US, you got to play by the US rules. It'll be interesting to see how that works globally. I mean, is a guy in Kenya going to do full KYC so he can have a US stablecoin, or is he just going to use Tether as long as it's available to him? I don't know. Uh, if the US really wants the world to buy their debt and buy stable coins, which then are used to buy the US's debt, they kind of need to make it easier for people, not harder. So we'll see. Strategic reserve and institutional demand converge. So, we probably know, Texas, Arizona have some state bills. The U.S. Treasury study is ongoing. We've got ETF inflows, minor accumulation. All of this is pulling Bitcoin off of exchanges, as we mentioned earlier. And again, the structural demand growth seems to be reducing the liquid supply base, which again is long-term bullish for price floors and the adoption curve. So maybe what we're seeing is a maturing of Bitcoin. Maybe we're going to see still volatility, but maybe less than we've seen in the past. Um, I'm sure we as soon as somebody says bear markets are over, then you're in for it. So I'm sure we're still going to have bear markets and bull markets, but perhaps the drawdowns are a little more shallow. But then maybe the ups are not as parabolic as they were in the past, which isn't. I mean, it's not a bad thing as long as Bitcoin continues to outperform every other asset in the world, which it so far in its history has pretty much done every year except for bear market years. Uh, let's go. Iron mining plus cloud growth with the AI. So their Iron has the mined 668 Bitcoin in August, so they were had a pretty good month. And their AI and cloud revenues are now at 98 percent margins, which are now 30% of their income. So they've kind of shifted some of their computing power over to AI and cloud. This diversification shields the miners from Bitcoin price cycles, which is pretty interesting. Big change from how miners operated in the past, which was their all their compute was for Bitcoin mining. Bitcoin mining, of course, can be shut down at a moment's notice if need be, due to energy grid demands and things like that. AI compute, not like that. Needs to be up 24/7, 365. So it's not flexible at all, but they're willing to pay. So that's good. The AI cloud trend is accelerating across public miner business models. They're not the only one that's in that game. And so again, it gives them something good to help support their business, and makes them a little bit more resilient, say in a Bitcoin bear market than they would otherwise be. On-chain fundamentals, let's take a look at that next. Pretty strong, 900,000 active addresses a day. $38 billion in transfer volume per day. Fees have been quite low. They're really at cycle lows. And again, largely probably to do with Lightning and SegWit scaling. So layer two taking some of the transaction flow away, less demand on chain. Um, On chain usage is steady despite the low fees. We've got healthy network fundamentals. And again, scaling upgrades are keeping transaction costs low, which supports adoption. Although it's not great for the miners, but at least they still get their block reward. Next up, cloud mining retail risk reminder. So if you don't know what cloud mining is, it's basically you pay a company who then buys the miner for you, plugs it in, and then you get some revenue share off of that uh, unit. And so, needless to say, that's it might be a easy way for you to participate in mining. Although personally, I would just go buy a BitAxe and plug it in at home if you really want to do that. You might not make as much Bitcoin doing that, but you're supporting the network. And if you find a block, well, good for you. Anyway, retail cloud mining promises something like a 5 to 7% annual percentage yield on your investment. So you put $20,000, $30,000 in, which buys a mining device, and then you're supposed to get a 5 to 7% yield on that. However, there have been multiple failures since 2022, Compass Mining, there's been others. So there's a lot of counterparty risk here, folks, which may outweigh the headline yields for many investors. Again, self-custody is the best practice risk mitigation. So if you really want to invest in Bitcoin, you're probably better off just buying Bitcoin if you have 20 or $30,000 to spend. And then spend a few $100 on get yourself some bit axes and plug them in the house someplace far away because they do make a little bit of noise and can be annoying. And Don't get involved in the cloud mining. That's my opinion. But anyway, do what you want. Miners, again, partnering with AI and HPC data centers. So 30 to 40% of revenue from AI HPC workloads at some facilities as compute demand grows. So again, miners seeing another customer, if you will, one that's not as flexible as Bitcoin. They need compute, they need a lot of it, and it needs to be on all the time. But again, as we mentioned earlier, it's sort of hedging the Bitcoin price and the halving cycles with steady compute income streams. And energy pricing plus grid capacity constraints will continue to remain long-term risks. So I guess the more the miners get into the business of providing AI compute, um, the harder it's going to be for them to shut down. Let's say if there's a power need on a grid and that sort of thing. So that's just going to drive the need to build more power plants. We need more power, Captain. Stablecoin laws are reshaping Bitcoin rails. So again, we've got the Genius Act, KYC, we've got reserve audits, monthly attestations mandated for US issued stablecoins. This is all in the legislation. This is probably going to raise friction and costs for issuers, but will boost trust for institutions, which will then make them all want to get in on the game. And it could accelerate Bitcoin native payments as alternative rails. Again, if it becomes too difficult to use stablecoins and it's easier to do a Lightning payment, then of course people are going to do a Lightning payment if they know how to do it. So the UX there becomes really, really important. Investor rotation to fundamentals is up next. So again, we're talking about falling equity premiums in some of the Bitcoin treasury space, the rising ETF inflows, the liquid supply all-time highs. These are all fundamentals that are driving price discovery. So what we're seeing really is the market maturing beyond these sort of speculative phases towards more structural demand growth, which is at the same time interesting and also maybe a little concerning. I don't know. Again, Bitcoin is for everybody, friends and enemies alike. If institutions want to own it, there's nothing stopping them. If you want to own it, there's nothing stopping you. So it's just that kind of a network. It's just that kind of an asset. So you have to accept that. But clearly, institutional and sovereign allocations are really shaping the narratives of the next cycle. And, I guess we all need to remember that while these guys can accumulate, and they are accumulating, they can also dump. So, so don't get too excited because, if all of a sudden they're like, oh, we don't want to own Bitcoin, and they start selling, then the market is going to tank. Um, but that's good because then you can acquire more until they realize their mistake, and then they buy again, and then, price goes back up. It's Bitcoin has no top because fiat has no bottom. So just have to remember that. And that's why hodling is the best position you can be in because you don't care. If you're levered, you care a lot. But if you're just holding it in cold storage, you're all good. Again, macro and Fed path ahead. We got 50 basis points priced by December. Real yields are down since July. We're could have a rally or not in Bitcoin. But typically we've seen that. But there's always the policy surprise or an oil shock or something that's going to throw you for a loop. So you always have to be a little bit careful about that. But again, if you tune out the noise and just dollar cost average and keep humbly stacking your sats, The dips are just going to be great buying opportunities, and if it rallies, you're just going to feel good about your stack, and so life is good. Long-term supply dynamics, again, 76% of Bitcoin unmoved over a year, which is an all-time high. Miner reserves and exchange balances are at six-year lows. So this is all structurally very positive for the Bitcoin price. Again, shrinking liquid supply each cycle raises the structural price floor that people are willing to pay to get Bitcoin. It's funny, I was talking to a friend the other day, and he's like, "Man, I wish I'd have bought it a few years ago." And I'm thinking to myself, well, the best time to buy Bitcoin was several years ago, but the second best time to buy it is now. Then he started talking about shorting it, and I was like, why would you do that? I mean, yeah, you can, but why? I mean, it's just, I don't know. Anyway, the digital gold scarcity thesis and adoption curve seems to be in place. And finally, let's wrap this up with the final segment. This is on FinCEN's proposed rules and Bitcoin privacy tools. I saw a lot of screeching online last week about this. They're coming for your Bitcoin, their privacy, and so I think it's just important to put this in context. I mean, it may be as bad as some people have said, but this is what I was able to find out. So in 2023, FinCEN NPRM proposed treating mixers, CoinJoin, unhosted wallets as, quote, primary money laundering concerns, which require AML KYC obligations. Now, privacy advocates argue that tools protect legitimate financial privacy. And let's remember, too, that these proposals are not yet law. And of course, the people that really need this are people that are, battling, authoritarian regimes, which I kind of feel like every government is turning into an authoritarian regime throughout the world. But some are worse than others, of course, and they debank you if you have different political views. And so these types of tools are super important for those folks if you believe in democracy, I guess. So there's public comments, and then there's policy debate ongoing with these proposals. The final rules are not certain. Um, the decentralized nature of CoinJoin does complicate enforcement practicality, which is why they don't like it, because it makes their blockchain tools not as useful to track where the coins went and all that. Um, the message here really is that Bitcoiners should maintain good OPSEC, keep using fresh addresses. I mean, they haven't been outlawed yet. And even if they are, I'd probably still keep using fresh addresses. It just makes you suspicious. You might not be able to do that on a KYC exchange, which means you might have to move your coin somewhere else. Something to think about. Um, I mean, if it gets bad enough in the U.S., I guess you got to move to another country. But I don't think we're there yet by a long shot. We still have a very, very supportive uh, leadership in the U.S. and in many states. I mean, I guess that's the other thing. You can move to a different state too. But keep your addresses fresh. Use open source wallets when possible. Avoid centralized privacy services, that kind of thing. So just keep that always in your mind. And really, this is a global debate. Privacy rights versus illicit finance regulation tension is growing. There just seems to be a view that uh, you don't deserve privacy because criminals, and that's just not right. I think I was reading somewhere where the argument of, well, you have a house, you have nothing to hide, why not just have a house with no curtains? Well, you don't want people staring in your house. It's not that you have anything to hide, it's just you have a right to privacy, therefore you install curtains, and sometimes you close them. So it's kind of the same thing with privacy for Bitcoin. The majority of us, I think, are not doing anything wrong with our Bitcoin, but we certainly have a right to privacy, and we should fight for that right. Um, so there. Well, that wraps up episode 181 of the Bitcoin Fortress podcast. We covered 31 Bitcoin only stories and tried to keep it factual, contextual, and give you the takeaways that you need. We do this every week. Once again, please check out this week's Bitcoin Fortress Substack feature. It's actually part two of a series I wrote, Bitcoin Under the Hood, and we'll include a link in the show notes to that. And if you haven't yet, grab both of my books on Amazon. Of course, my first book, Bitcoin Fortress, A Simple Guide for Beginners, has been out for a while, and I just published last week the Bitcoin Retirement and Estate Planning book, which is now available. A a pretty detailed book, a little technical heavy, but I tried to keep it light and understandable, but really a guide for Bitcoiners like myself on how to navigate those areas when you're all in. And so hopefully you enjoy it. And then stay tuned for my next book. It's tentatively titled The Bitcoin Lifestyle, and that will be coming up soon. So keep an eye out for that. And until next week, stay humble, stack sats, and keep your fortress strong. Bye bye.